Hey everyone, welcome back to Corporate Decoder, the place where we unpack the complex world of corporate finance and find the hidden stories. And let me tell you, today's filing from Digital Turbine Incorporated is quite the roller coaster, almost like that last turn on a roller coaster, where you are not sure if you are going up or down. This is Digital Turbine's quarterly report, a peek into their financial health for the period ending the 31st of December 2025. Think of it as their financial checkup, and we're here to read the doctor's notes before we dive deep if you love getting clear insights from these dense financial documents. Make sure you hit that subscribe button and ring the notification bell. And hey, we've got a fantastic community discussing these reports over on our Discord, linked in the description below, so let's get started. First up, the balance sheet. This is like a snapshot of what the company owns and what it owes at a single moment. As of the 31st of December 2025, Digital Turbine had total assets valued at a hefty $858 million. That is a lot of stuff, but they also owe a good chunk of money, with total liabilities sitting at a little over $663 million. What is really interesting here is the big jump in accounts receivable, growing from about $181 million to $245 million. That means they billed a lot more but haven't collected it yet. It is not necessarily bad, but it means their cash is tied up in money owed to them. Let's look closer at those receivables. They ended up with over $245 million in accounts receivable. That is a significant increase from the previous period. It suggests they've been doing a lot of business, which is great, but it also means a lot of cash is still out there, waiting to come back into the company. Now, let's talk about goodwill. This is a bit like the intangible value of a company, often arising from acquisitions. Digital Turbine's goodwill has crept up a little to about $223 million. This suggests they've either made another acquisition or the value of their existing ones has increased. On the other side of the balance sheet, we see their liabilities and stockholders' equity. Their total liabilities are around $663 million. What stands out is the significant amount of long-term debt, sitting at over $350 million. That is serious borrowing. They also have preferred stock, which is a special kind of stock that usually comes with different rights than common stock. Right now, they have about $100 worth of preferred stock, which is pretty small in the grand scheme of things. Then there is additional paid-in capital, which is basically the money investors have paid over the stock's par value. This has grown considerably, now sitting at over $964 million. This indicates strong investor confidence and a lot of investment coming in. And here is a big one, the accumulated deficit. This is the running total of all the company's losses over time. It is currently sitting at a negative $717 million. While they're showing profits lately, historically they've lost a lot of money. Let's move on to how the company is actually performing, its income statement. For the 3 months ending the 31st of December 2025, Digital Turbine brought in $151 million in net revenue. That's a solid 12.4% increase compared to the same period last year. More importantly, they actually made a profit of over $5 million compared to a loss of $23 million last year. That is a huge swing. Looking at the revenue breakdown, the on-device solutions segment saw revenue climb by 8.5% to about $99 million for the quarter. The app growth platform segment did even better, jumping 18.9% to over $52 million. This shows growth across both their main business areas. Now, let's talk about costs. Product development expenses, which is money spent on creating and improving their technology, actually went down slightly by about 3% to just under $10 million. They are spending less on developing new products, which might be a strategic choice to focus on existing ones. Sales and marketing costs also saw a decrease of about 7.5% to $14.3 million. This is interesting. They are spending less to acquire customers. This could mean they are becoming more efficient at marketing, or it could be a sign of belt tightening. And look at this, general and administrative expenses, which cover things like management and support staff salaries, dropped a massive 32.5% to about $28.9 million. This is a huge cost reduction. It seems they've really cut down on overhead, which is definitely good for profitability. This all leads to the bottom line income from operations. For the quarter, they made a profit of over $21 million, a massive turnaround from a loss of nearly $13 million in the same period last year. This is the kind of exciting shift that makes investors pay attention. However, not all costs are going down. Interest expense, which is the cost of borrowing money, shot up by over 71% to $13.5 million. This is because they have more debt and interest rates have gone up. This is a significant drag on overall profitability. They also had a loss on extinguishing debt. This happens when a company pays off old debt and takes on new debt, and there are costs associated with that process. In this case, it was zero for the quarter compared to the previous year, but for the 9 months, it was almost $10 million. This highlights the refinancing activity we'll see more of in the debt section. And finally, after all is said and done, they actually had a net income of over $5 million for the quarter. That is a huge leap from a net loss of over $23 million a year ago. This is the most critical takeaway from their operations. Now, let's look at cash flow, the lifeblood of any company. For the 9 months ending the 31st of December 2025, Digital Turbine generated $37.4 million in cash from operations. This is a massive improvement from just $372 in the prior year. This surge is largely thanks to the reduced net loss and improvements in how they manage their working capital. The jump in cash from operations from a meager $372 to $37,424 is truly remarkable. It shows the company is becoming much better at turning its revenue into actual cash, which is a vital sign of financial health. In terms of financing activities, the picture is a bit wild. They borrowed $418 million and repaid $466 million in debt obligations, which includes paying off their old credit line. They also raised $56 million through their stock. It looks like they are actively managing their debt, paying off some and taking on new larger loans. The financing section shows a lot of movement. They took on a huge amount of new debt, over $418 million, and then paid off a significant chunk of their old debt, over $466 million. They really seem to be restructuring their borrowing. This brings us to their debt. It seems they've been busy refinancing. On the 29th of August 2025, they entered into a new financing agreement. This agreement provides for up to $430 million in term loans, and they borrowed the full amount. The interest rate on these term loans is variable, currently at a pretty high 11.68%. This means their interest payments will go up if interest rates rise further. This is a significant risk. Adding to the complexity, they also issued warrants to the lenders. These are like options to buy the company's stock in the future. The company has to account for these warrants as a liability, and their value can change, impacting the company's income. As of the 31st of December 2025, these derivative liabilities were valued at about $4.4 million. Let's briefly touch on their business segments. They operate two main ones, on Device Solutions or ODDS and App Growth Platform or AGP. ODDS focuses on delivering apps and content to devices, while AGP helps advertisers and publishers monetize their users through ads. Both segments are showing revenue growth, which is a positive sign, with AGP growing faster this quarter. We saw goodwill increase slightly to $223 million. The company states they have not identified any goodwill impairment, which is good news, meaning they believe this intangible value is still worth what they paid for it. Their intangible assets, which include things like customer relationships and developed technology, are valued at $226 million. They are amortizing these over time, which is standard practice. Let's revisit accounts receivable. The amount has grown significantly, and the allowance for credit losses has also been adjusted. This means they are setting aside a bit more money to cover potential bad debts. It is a wise move given the jump in receivables. Their property and equipment, including computer hardware and software development, stands at about $49 million. They also have capitalized implementation costs for cloud computing arrangements, which is a growing area for the company. Okay, back to the debt, because it is a big story here. They refinanced their credit facility on the 29th of August 2025, taking on $430 million in term loans. These loans are secured, meaning the company has pledged its assets as collateral. This is a big commitment. Looking ahead, they have significant principal payments due, especially in fiscal year 2030, where a large chunk of $349 million is due. They are also required to pay escalating exit fees and duration fees if certain tranches of loans are not repaid by specific dates. This refinancing, while providing capital, also comes with significant future obligations. To help manage these obligations, Digital Turbine has been selling stock through an at-the-market offering. They've raised about $58 million from this program. This is a way for them to get cash by selling shares directly to the market. However, they also decided to terminate this program in February 2026. They also have stock-based compensation plans. This means they give stock options or restricted stock units to employees. This is a common way to incentivize employees, but it also dilutes the ownership of existing shareholders. They have a good amount of unrecognized compensation expense related to these plans. which will be expensed over the next few years. Now for earnings per S-Hair, for the quarter they reported a positive $0.03 per S-Hair diluted earnings. This is a massive improvement from the previous year's loss of $0.22 per S-Hair. This clearly shows the company is moving towards profitability. Interestingly, their income tax provision for the 9-month period ended the 31st of December 2025, resulted in a negative effective tax rate. This can happen due to various tax strategies and credits, and it seems they benefited from some tax law changes signed in July 2025. The company has also been undergoing a transformation program including workforce reductions. They incurred costs for this in the past, but for the 9 months ending the 31st of December 2025, no direct costs were reported from this program. They claim this program was targeted to save over $25 million annually, which helps explain the big drop in general and administrative expenses. They have commitments for hosting agreements totaling over $200 million over the next 5 years. This is a significant operational commitment. They also mentioned they could be involved in various legal matters, but they haven't accrued any specific liabilities for them, suggesting no major ongoing lawsuits are currently impacting their financials. Digital Turbine is exposed to market risks, primarily interest rate fluctuations and foreign currency exchange. Their variable rate debt means rising interest rates hurt them directly. While they operate internationally, they try to mitigate currency risk by transacting in US dollars where possible. We've already mentioned the termination of their at-the-market offering, which signals a shift in their capital raising strategy. So what does this all mean? Digital Turbine is in a much better place financially than a year ago. They've significantly cut costs, especially general and administrative expenses, which has led to actual profits and positive cash flow from operations. This is a huge win. The revenue growth in both segments is also very encouraging, showing their core business is strong. However, there are definite risks. Their debt load is substantial, and the variable interest rates make them vulnerable to market conditions. The large increase in accounts receivable needs monitoring to ensure cash collection keeps pace, while they seem to be managing their debt structure. The refinancing and new loans come with significant future obligations and secured collateral, which is a serious commitment. The termination of the ATM offering might suggest they feel more confident in their operations, or are exploring different financing avenues. Overall, Digital Turbine appears to be executing a turnaround. They've tightened their belt and focused on profitability, and it is showing results. The key will be managing their debt effectively and continuing to grow their revenue streams without taking on excessive new risks. They've proven they can generate cash when they focus, and that is a very positive sign for the future, assuming they can navigate the ongoing interest rate environment and their significant debt repayment schedule. Alright, that is our breakdown of Digital Turbine's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their cost cutting and debt restructuring are smart moves? Drop your thoughts in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more deep dives into company reports. And don't forget to join our growing community on Discord, linked in the description. Thanks for watching, and we'll see you in the next Corporate Decoder.